Welcome to our YIS Global Online Club meeting today. This week, we're going to be going over Unit 6, the Intro to Intrinsic Value. And with me today, I have Pranay. Pranay joins us from New Jersey. Pranay, tell us a little bit about yourself, and I will also brag about you as well.
So I'm currently a senior in high school, and I'm looking at majoring into computer science and economics when I enter college. I've lived my entire life in New Jersey, and I'm trying to stay close to home when I go to college.
Very nice. So those of you who don't know Pranay is on our student advisory board, and he also was the winner of a New Jersey State stock pitch competition, I want to say a couple years ago. And yeah, he's also one of the UN delegates, right, Pranay?
Yep, I've been doing Model UN since high school, so since 9th grade.
Nice. All right, well, whenever you're ready, you can go ahead and start.
So good afternoon, everyone. Today, we will be doing an introduction to intrinsic value, which is one of the key measurements to find good stocks to invest in. So before we go on, just a couple of current news that we want to cover from the market. So obviously, how can we not talk about GameStop and the Reddit group Wall Street Bets, which basically blew up the internet 2 weeks ago? So just to give a quick backstory of someone who may not know what happened. So basically hedge funds, which are basically billion-dollar corporations that tried to either short or buy stocks and kind of raise or lower the prices of the stocks. They play a big part in that. They try to short GameStop, AMC, and other stocks, which reasonably makes sense because GameStop right now is probably the most obsolete store because you can find everything online. AMC, the theaters are shut down. So they had good reasoning behind it. However, users on Reddit, they came together and they had objections to these shorts because the companies, the hedge funds that shorted them, publicized their findings. And the people on Reddit were able to see, and they came together and bought these stocks, poured in thousands and hundreds and thousands of dollars to help the price rise. So I saw a statistic that I read it today that about 30% of Americans were investing in GameStop and these other stocks in the last month. So that just shows the reach that this had on the US stock market. So they came together and helped these prices rise. So the hedge funds who shorted the stocks were forced to sell their position on the shorts. So when you short a stock, it has a lot of actually uncertainty and risk to it because the loss is unlimited because theoretically the stock price could reach infinity if everyone buys and no one sells it. And that's what basically started happening in this case. GameStop, AMC, they start to rise thousands of percent points. And the hedge funds, after running out of the capital they were forced to sell their positions on the shorts, causing a short squeeze, meaning that once they bought it and sold it at a higher price, the stock price, because the hedge funds who pour billions of dollars into this, inevitably helped the price rise even more. So that's basically the fiasco behind GameStop and Wall Street Bets that happened last week. It's died down to an extent now, but there was also a lot of drawback about certain apps such as Robinhood, which limited the transaction of these stocks. So moving on from that, recently Elon Musk, he started to accept Bitcoin as a form of currency for his company Tesla. So he bought about $1.5 billion worth of Bitcoin. And this substantially helped the price of Bitcoin rise. It went from about 34,000 to almost 50,000 in one day. And he also helped the cryptocurrency Dogecoin, which is not many people knew about it until now. But because of Elon Musk, he was able to help the price rise from about less than 1 cent to almost 10 cents right now. So that just shows it's outside of the stock market because cryptocurrency is another world, but just because they're related to the same world, and how Tesla, which was another company, saw similar rises. And then finally, the stock market reached an all-time high. So this is actually a recurring trend. It's been setting new records basically almost every day now. So it's been a continuing trend from the past couple of months. And earnings reports from certain companies crushed expectations in February and at the end of March, which helped push this rise. And is it a sign of more things to come once the pandemic is resolved? Because businesses will be able to reopen, people will be able to buy more stuff and help the economy. So these are just a couple things that are going on with the stock market. And now we'll go into intrinsic value. So what is intrinsic value? So in simple terms, it basically means what you think the true value of a company should be. So it's as simple as that. So let's say if a company's stock is trading at $20, but you believe that their future has potential, that they're in a fast growing industry. You believe that their true price should be $40. That's your intrinsic value. And your goal as an investor should be to buy shares of companies whose stock prices do not actually reflect their true value. So it's kind of buying, it's the term buying at a low price, selling high. That's basically what intrinsic value is. You have to decide what the high value is that you find, and buy it when it's lower than that and sell when it rises to that value. And then being able to correctly estimate the intrinsic value of a company is one of the most important skills to become a successful investor, because you'll be able to catch these trends before many people start buying it. So you'll be one of the first ones, which helps you find new stocks to invest in and make profit off your what you put in. So before we go on, this is a quick introductory video from James Fletcher, who's founded YIS, about what kind of introducing what intrinsic value is.
Hey investors, welcome back. Think of your favorite product, an Apple iPad, a Chipotle burrito, a Gucci handbag, or my personal favorite, a Tesla Model S. All of these things are products that can be purchased at a certain price. But who sets the price? Who decides how much we pay for something? Who decides how much something is worth? Let's take my Tesla Model S as an example. A fully loaded Tesla Model S new would cost roughly $110,000. Let's say that's what it's worth to me too. So I would call that my intrinsic value for the Tesla. So let's say I walk into a Tesla store and they're only asking $20,000 for a brand new Tesla. I would instinctively know that the price that they were asking was far below the true value or the intrinsic value. And if I walked in the next day and they were asking $1 million for the Tesla, I would clearly walk away because the price that they were asking was way above the intrinsic value. One of Warren Buffett's most successful investments ever was a stock called PetroChina, the largest oil company in China. He invested $500 million into the company that turned into $3.5 billion, billion with a B. In a rare interview, he provided clues into the process he used to evaluate the investment. So take a look at the clip below and see if you can learn some of Warren Buffett's secrets.
For the average person who's maybe never bought a stock before, what's your advice about that? You can't constantly sit there and wait and say, oh, it's going to go higher, it's going to go higher.
We don't even think about that. What we think about is how much is it selling for, how much do we think it's worth. When we bought it at $35 billion effectively, I felt the company was probably worth at least $100 billion.
How did it come to your attention? How do you find a stock like PetroChina?
I sit there in my office and I read an annual report, which fortunately was in English, and it described a very good company. And told about the oil reserves, told about the refining, told about the chemicals, everything else. And I sat there and read it, and I thought to myself, this company is worth about $100 billion. Now, I didn't look at the price first. I look at the business first and try and figure out what it's worth, because if I look at the price first, I'll get influenced by that. So I look at the company first. I try to value it, and then I look at the price, and if the price is way less than what I've just valued it at, I'm going to buy it.
And how do you value it?
Well, that's the trick. Yeah. But it's essentially what I would pay for the whole business if I could buy it. And when we sold the stock, it was valued, we'll say, at probably 250 to 275 billion.
Note that Warren Buffett makes a crucial distinction into what the business is really worth and what the stock is trading at. He said he doesn't even look at the stock price. He first looks at the business and its numbers, and then calculates what he feels to be the intrinsic value. After that, he looks at the stock price. And the goal of great investors is to buy a stock whose market value or price is much below the intrinsic value, just like Buffett did with PetroChina. In this unit, we'll walk you through some of the ways investors are able to calculate the intrinsic value of companies.
From that video, we saw the importance intrinsic value has, and even great investors like Warren Buffett, they use intrinsic value as a basis for their investments. So a couple of questions to consider. So this is just a simple price time graph. And the market price, or the price that the stock is currently trading at, is in black, and your intrinsic value, what you think it's worth, is in the red line. So looking at the graph, a couple things to look at. One of the times that you would want to buy the stock. So as you mentioned before, you want to buy it when you think that the intrinsic value is much higher than the market price, or what it's currently selling at. So if you look at the graph, a couple times you could have bought the stock was right in the beginning when the black line was below the intrinsic value, trading below it. and then when where it's labeled underpriced right here, because you clearly see that the market price is not what you think the intrinsic value is, and vice versa. So where you think that you want to sell the stock, it's when the market price is selling above your intrinsic value, meaning that you will think that the price will come back down. So again, where it's marked overpriced, where it's above the red line, that's where you would be hesitant about buying it, because that's above what you thought the intrinsic value was. And another key question is, why do you think that the market price is more volatile than the intrinsic value of a company? So I'll actually open this up to the other students if they want to answer.
Maybe because the stock market is really emotional. Like, for example, I guess like GameStop was a great example, since people started buying the stock just because of what, Redditor said. And of course, much other companies have done the same thing. People just invest in a company that they know pretty well.
Yeah, you hit the nail on the head there. So basically, because every day there could be different various reasons where the price would change for a stock. For example, if earnings report came out and it did not meet its quarterly expectations, and therefore the market price could dip down. And vice versa, if news came out that a company was acquiring another smaller company and the market price shot up. But intrinsic value relatively remains the same, because the value that you think the company is at for the future does not change based on day-to-day things that happen. So before, as you mentioned, let's take the GameStop example before, how you said that when GameStop was trading at about $8 per share, no one thought that it would be worth $300 per share, because that's unrealistic looking at its business model. So when that happened, people tried jumping on the trend, and it actually worked out for most people because it rose so much. But right now it's coming back down to about $20 per share, around that price. So it just sees how the intrinsic value that you had for the company will be the relatively like long-term price where you want to buy it at and sell it when it rises to that price. So how exactly do you calculate intrinsic value? So because this is an introductory course or introductory lesson, we won't get into these methods too in depth, but just a couple valuation methods if you want to research before the next class are discounted cash flows model and the relative valuation method. So the Dcf model is one of the ones that I actually use for when I did my stock pitch competitions, when I used to evaluate stocks. So that takes into account metrics such as the PE ratio, revenue growth rate, net margin, to form an intrinsic value. So it basically sees if the company is actually making substantial progress based on their income and their business model from year to year, and to see that its PE ratio is lower than its competitors in the same industry, meaning that it's higher long-term growth potential. And basically net margin shows that the company, however much income it makes, it's able to keep much of that income instead of spending it on the cost of what it makes. And it's thus able to either put it back into the business, invest it, or give it back or increase the share price that way. So we will not go into these methods too in depth, but if you want to guys just quickly note these two methods down and look into it. And help you decide like the price. So once you do the formula and put the numbers and you form your own valuation method, you're able to find a price that you think the intrinsic value is. So for example, one of the stocks I did, I found the intrinsic value was about $450, and it was for Lockheed Martin actually, and the price was around 300. So Lockheed Martin's in a relatively slow growing industry. It's in the aerospace and defense industry. So that's one of the slower growing industries. But I saw that had the potential to go up to 450 because how much the US military relies on Lockheed Martin for its products, as well as the revenue growth rate that it had. So I made my valuation for Lockheed Martin at 450, which was a little bit more on the more optimistic side, but currently it's up about $40, $50, I would say. So that just shows how use the P ratio, use the intrinsic value to kind of judge where you think the company is going to go, and then invest based on that. So that was just a quick summary or introduction to intrinsic value. And it's important that from an early age that you guys kind of form these analysis so that you guys can find the best stocks to invest in using a more grounded approach, using math and numbers instead of just investing based on sentimental values such as news or any other opinions.
Does anyone have any questions for Pranay about intrinsic value? Like I said, this was going to be a shorter lesson today just to go over the introduction of what intrinsic value is. We'll get into deeper aspects within the next couple of weeks. Before we go, guys, I just want to remind you, if you want to attend our global investment symposium, we have 3 of them. We have one for the US, one for Hong Kong, and one for India. The US is coming up February 19th. I will be sending out the Zoom links either later this week or early next week for that. But if you haven't already participated or clicked to participate, it's on our events page on our main website, yis.org/events. It's going to be a really great event. We have some really great guest speakers coming to talk about really cool stuff, fintech, AI and investing, Bitcoin and cryptocurrency. We have all kinds of specialists in all of the fields that are going to be taking your questions as well as doing a discussion. So it should be awesome. So look for that. Global Investment Symposium, February 19th. So till next week, guys, I'll see you.
Thank you.
Have a good weekend.
Bye.